Hello and welcome to Chapter 13. Chapter 13 is the last chapter in the where we cover stuff on the balance sheet. In particular, what we're going to do is talk about common stock and preferred stock, which you haven't seen before, and dividends as well, and how the dividends, which are distribution of profits, go back to shareholders. So let's get started on Chapter 13. Bear with me just a minute. Okay. First thing we're going to do is we're going to talk specifically about what are the characteristics of a corporation, because a corporation has shareholders. And what are things that are associated with shareholders? That's the foundation of what we're going to talk about in this this first learning objective. Corporations are organized under state law, and they are a separate legal entity. And what does that mean by them being a separate legal entity? They are separate from their owners, and they are an entity unto themselves. And corporations dominate the size of business within the United States, and you have many well-known corporations. For example, Walmart is a corporation, and most well-known companies are corporations. What are some of the characteristics? One is that it's a separate legal entity, meaning that there's a division between the shareholders and the liability between the shareholders and the legal entity, so that if something were to happen and a corporation got sued, for example, Volkswagen got sued about this issue with the emissions with their diesel engines. Well, because they did, the shareholders at Volkswagen can stand to lose the money that they've invested in the business if, say, Volkswagen were to declare bankruptcy. But what they won't do is that's the maximum they can lose. They can't go back and go from there. That kind of goes in line with the third one. The number of owners, it can be infinite, and basically they don't have to worry about what happens within the business. And you have this lack of mutual agency. What that means is if an organization makes a commitment for something, they are not responsible for what the shareholders are not responsible for that. They're just going to live with it. An indefinite life means that the organization, a corporation, could continue to exist even if something were to happen and the members don't want to be involved. Taxation in a corporation, there's actually something called double taxation. And in its simplest form, a corporation gets taxed on its income, but then when they shift or when they sell or they give dividends for the income, the shareholders also get taxed. So it's double taxation. And for corporations, they can accumulate capital much easier. They can do a share and issue a share. Like, for example, Mark Zuckerberg, they did what's called an initial public offering for Facebook. And when they did that, they got a certain number of shares. Well, that's a way that Facebook got people to invest in Facebook. Not you guys that are members of Facebook, but people that are in the investment community, let's say. And so here's some of the advantages of a corporation. They can raise more money than, say, a proprietor or a partnership. It has a continuous life. They can transfer ownership. Transfer of ownership is really easy. They do it by selling shares one to another, and it's just a common transfer of ownership. There's no mutual agency, and the mutual agency stuff means that one doesn't bind the other, and it has limited liability. The maximum a corporation can lose, owners and stockholders in a corporation can lose what they've invested. That's it. So if you invest $100,000 in a corporation, that's the maximum amount of money you can lose. What are some of the disadvantages? Ownership and management are sometimes separated, and you say, well, why is that important? Because if ownership is separated from management, management may have different goals and objectives than, say, ownership. Ownership, what they really want is they want to maximize shareholder value. Management may want to continue to have a job, and sometimes they are mutually exclusive. They're not equivalent to one another. Second one here, double taxation, we touched on a little bit, where you get taxed on the income of a corporation. And when you have this distribution of profits called dividends, the people that get those dividends are taxed on that as well. And the startup costs for this are much higher. And then the last one here is government regulation of corporations is much more extensive than, say, a sole proprietorship or a partnership. And so what's some of the stockholder equity basics? This is just basically stocks. You have, the first thing you have something called authorized stock shares. And authorized stock shares tells you how many shares of stock that the company can issue. So maybe they're authorized 100,000. Maybe they only issue 20,000 shares of stock. So typically, and always actually, the number of issued shares is going to be less than or equal to the number of authorized shares of stock. And then the outstanding is only the shares that stockholders hold. The difference between the two of those is something called treasury stock, and we'll talk about that in a little bit. And stockholders get stock certificates, and they're basically pieces of paper printed on fancy paper still. And you have capital stock represents the ownership of the company and what portion they own in a company. So here's what a stock share looks like, or a stock certificate. This one's for Smart Touch Learning. I'm not going to spend a lot of time on this. You can take a look at what it does. And the paper is basically, it feels kind of like paper money, these stockholders. So if you get, or sometimes you might get a certificate for appreciation or something like that. That's really fancy. That's what these are for. And you notice there's certain things on this as well. I'll let you spend some time looking at that. So here's a pictorial of the stock. And what you have is you have the outside circle. This blue circle says the authorized stock. That's the maximum number of shares that can be issued. And then the middle one is the authorized and issued, that has been issued, and they may be held by shareholders. Then you have authorized, issued, and outstanding. You notice that the circle is smaller. So outstanding, authorized, issued, and outstanding is going to be the smallest number. And then the middle number is going to be authorized and issued, which means it's going to be smaller than authorized, etc. So this is just a pictorial of the same thing we just touched on. What are the rights for stockholders? You can vote on ownership issues and also who's on the board of directors for a corporation. And for dividends, you receive a portion of the profits for the business. And liquidation, if a company liquidates a company, they get their portion of that money, the assets remaining after liquidation. They get a proportionate share. And the last thing is something called preemptive right. And what preemptive right states is they can maintain the same ownership right in the corporation that they have already. What percentage? Because let's say, for example, a corporation, let's say you own 10% in the corporation, and you're exerting some influence on that corporation, and they determine that they want to kind of cut you out. They want, because you're just being too ugly, or you're doing something not right, or you're pushing the corporation in the wrong way because of the number of shares that you have. Well, they could go issue more shares in what they would call dilute the number of shares that you have. And what that would mean is that if you didn't have this preemptive right, they could take away the right for you to influence the business. And I suspect this came from way back in the day, probably in the 30s, when businesses tried to do that because they wanted to wrest control over what they might call maverick shareholders. There's two different types of capital stock, and this is all part of stockholders' equity. There's common stock and preferred, and they can either be issued at par or no par, or they can also issue them at stated value, which is basically also another form of a no par stock. And all that really does is it establishes the legal capital for the business, and we'll get into the difference between these two. Very straightforward, very simple, but an important concept nonetheless. So, and then you have stockholders' equity. There's two sources of stockholders' equity. The first one, it says paid in capital here, but really what that is that's when you issue either preferred or common stock. That's called paid in capital. And retained earnings, if you remember all the way back to chapter 1, that's when a business makes money. They put that money on their balance sheet. So if they take their net income, one of the things you do is you close the income statement into retained earnings. And so that's what retained earnings is. So let's talk about journal entries. We're in Principles 1, so journal entries are the things that we're going to do. And we're going to talk about how to journalize the issuance of stock. And and why we issue it. Well, we're going to issue it through a company. You can either issue it directly in order to get stock, or you can issue it through an underwriter. And you're going to do this through the New York Stock Exchange. And typically, if it's a brand new stock issue, you're going to hear something called an initial public offering. If it's new stock, it's just going to be additional stock. And the issue price is what the company gets for the stock. And if they issue, and this is one where they issued, it says here that they're authorized, and this is a really good one. It says that the company was authorized to issue 20 million shares of stock, but they issued only 15,000 shares of stock, and they issued them at their par value. So you notice here, when you issue at par value, you're going to debit cash and you're going to credit common stock for the par value for both. And if we had something where you issued it at greater than par, this par number down here that you see is really what you're going to use for common stock, and the rest is going to go in an account called paid in capital in excess of par. That's going to be the next thing we'll look at here shortly. And here's how you do it. If you issued common stock at a premium, so we issued this common stock, we issued notice we issued them now at $5 a share, where in the last slide we issued them at $1 a share. And the par value is $1 per share. So we have a difference of $4 per share. So we're going to take that difference in $4 per share and we're going to put it into this account called paid in capital in excess of par common, $4. And the distribution still comes to be the same to 15,000 because they got 15,000 in. But a certain portion of it is in this common stock account and the rest is in this paid in capital in excess of par / common. Preferred, and I generally will use an acronym PIC, just short for paid in capital, because that's a long account description. And here's what it will look like on the balance sheet. So they had 18,000. They issued 18,000 shares, and you notice this is 18,000 times $1. That's where this $18,000 come from. And apparently they issued some of them over par value, and we can calculate what that is, but I'm not going to go through that. And this last part here is retained earnings, and that means that the business had profits for a period of time, and so they continue to have profits. So here's the next set of journal entries, and you notice here these are ones where they issued the stock. And you notice both of these examples, they issued 15,000 shares for $1 per share. They debited cash and they credited common stock. You notice here though, this says no par value. Since it has no par value, you're not going to separate this between paid in capital and common stock. You're just going to leave it in one account. And down here, the same thing. You issued $5 per share, 3,000 shares, 15,000, you're debiting cash, and you're crediting common stock no par value. Notice when it has no par value, you don't have this paid in capital account. You're not going to have a paid in capital account because all that really does is it provides a way for you to divide the amount of money that you've got between common stock and paid in capital. And here's what it looks like if you had no par common stock, it's just $30,000. If you do it at stated value, what's the only difference here? Where it says par value, it now says stated value. Everything else looks the same, has the exact same character. 15,000 still for cash, 3,000 where you have a stated value per share of $1, and then you take the difference between the two and it goes into the paid in capital. But you notice the one difference here where it said par, in the other one this says stated value. Okay, now here's kind of an interesting example of something different and how would this work. This might be a company that's a small company, but it's still a corporation, and the owner might have said, "Well, I'm gonna put $18,000 worth of furniture in the business because I have it in my personal stuff right now, but I'm gonna get some shares of stock for it." So what they did is they took the market value of the furniture, $18,000. They looked at the common stock par value, that was set as $1, so they put that as 5,000. And then the difference between the 18 and the 5 goes into this paid in capital in excess of par for 13. Remember, this par value thing, all it really does is creates an anchor for you to divide between common stock and paid in capital. Okay, now here's another one. Now this is a little different because now we're talking not about common stock, but preferred. And preferred stock is kind of a hybrid between common stock and a bond. A common stock basically you can get money in the profits. And you do the same with preferred, but you notice now in preferred you have this interest rate. And what that tells you is that if they issue a dividend, you're going to get 6% of what you put in the business. And we'll talk about that a little bit more later. Character is the same though. Notice it's $50 par value in this case. So they have $50 par value. So that's where this 50,000 comes from. And they had a difference of $5 a share times the 1,000 shares. That's the 5,000 comes from. So you have a total of $55,000 that came into the business in this account called preferred stock. And recall, preferred means that you're going to get preferential treatment. Okay? Here's how it looks now on the balance sheet. You have preferred and you have common stock and you have your paid in capital, and the retained earnings stays the same. So we're building on the same balance sheet that we had before, but this is one of the differences. Now, treasury stock is a little different. Treasury stock is a contra equity account. Excuse me. And when I say contra equity, that means it has an opposite balance of the normal balance in the equity. A normal equity balance is going to have a credit balance. In this case, treasury stock is going to have a debit balance, and we'll talk about treasury stock and the transactions for that. And what it is it's stock that the company buys back. And what they're doing is they're buying these shares of stock back for several different reasons. One, to increase the value of the net assets, buying low and selling high, in other words, making money. Two, to support the company stock price. They think it's undervalued. The third one, to avoid a takeover, because if there's too many shares of your company stock outstanding, somebody may want to go out and buy those. And the last one, you know where it says reward a valued employees with stock? Really, some companies have what they call employee stock ownership plans. And in an abbreviation, you might hear sometimes it's called an ESOP. And what they're doing is they're buying shares of stock and they're going to turn around and resell them to you. What's the basics? It's, as we talked about earlier, it's a contra equity account. The normal balance is a debit. It's recorded at cost, and we could care less about the par value. And it's reported beneath the retained earnings on the balance sheet as a reduction of equity. So let's talk about a transaction. The company bought 1,000 shares of common stock, paying $5 per share. So when they bought it, their cash went out, and then they increased this account called treasury stock common for $5 per share times 1,000 shares, so it's $5,000. And then if they turned around and they sold 100 of those shares, what they're going to do is they're going to take whatever they got for them, and then they're going to take it out of the treasury stock account at the value that they put it in at $5 a share. So you have $5 a share times 100 shares. They're going to take $500 out of that account. Another transaction, same kind of deal. $6 per share. Now they've made a profit. They bought them for $5. You can see that here. They sold them for $6. Well, that profit that they made on the 200 shares goes into this account that's called paid in capital treasury stock, $1 per share. So that's this transaction here. You have another one. This transaction, they lost money. So what they're going to do is they're going to take money out of that paid in capital account. And remember, again, when they sold these 200 shares, they're still taking them out at the value that they put them in at, 200 times 5. And they have 70 cents that they lost per share. So they're going to take that out of their paid in capital treasury stock account. And that's a debit now, not a credit. So that's losing money. And then finally, they have another 200 shares that they sold, and this should be the last of them. When they sold those, they took them out, 1,000 at the value that they put them in at. They had retained earnings. They had paid in capital treasury stock of 60, because this is all that was left in that account if we track that account. And then if you look at this, the rest of it has to come out of retained earnings because they basically lost money. The 1,000 that they originally had, the 1,000 here, less than 900, less the 60 says the remaining has to come out of retained earnings. This is probably going to be one of the most difficult things that you'll struggle with in this chapter. And here's what happens. And it looks like they have 1,500 shares, so it looks like they still have 300 shares outstanding at $5 per share. The rest of this still looks to be the same. So now this is where we have dividends. And dividends are a distribution of profits. And we have cash dividends, and stock splits. Each one has a little bit different character as far as what happens with the business and how it works. Cash dividends are basically going to say they're going to look at shares issued and outstanding, and they're going to do a certain amount of cash dividend. And then stock dividends are going to be that they're not going to give you any money, but they're going to give you shares of stock. And stock splits just says if you have 2 shares, now you're going to have 4 shares. For example, they split stock. So each one of these is a little bit different. And dividends are distribution of profits, and they're paid in the form of cash, stock, or other property. Typically, you don't see this other property stuff very often. And this legal capital refers to the amount of stockholders' equity that cannot be used for dividends. And so you have 3 particular dates that you have to deal with cash dividends. You have the declaration date, the date of record, and the payment date. And each one of those is a little bit different, and we have to do journal entries on certain dates. You do a journal entry on the declaration date and on the payment date, but you do not do a journal entry on the date of record. The declaration date says we're going to pay a dividend per share, and it might say the board of directors voted to give a 50-cent per share dividend for shares of for owners of record on this particular date with a payment date of another date. And you're going to ask, well, why do they do that? They know who the owners of record are exactly on that date. Well, the reason that they do that, I think, is probably back in the day, there's no way they could have kept track of the owners of record as quickly as we can today. So I suspect this is a historical way that they've looked at this shareholder stuff. And so here's what happens on the payment date. I mean, on date of, this is on the declaration date. And what they do is they debit cash dividends and they credit dividends payable common. So they're going to have to pay it, and then they're debiting that, and they're going to actually pay it out later. And this is going to be a reduction in the equity section, and this is going to be part of the liabilities. So 50 cents per share on the outstanding shares of 22,000. So this is on the declaration date, but it's only on outstanding shares. So you don't want to have it with treasury stock. You don't pay treasury stock. You don't pay a dividend on treasury stock. And then when they make the dividend, what they do is they don't do anything on the date of record when they're checking the shareholders, but on the payment date when they pay the dividend, they're going to debit dividends payable and credit cash. And then this bottom one, this is when they close out the dividends, cash dividends. When they close that out, they're going to close it out to retained earnings. Now, preferred stock is a little bit different because in preferred stock, you can pay what's called a dividend in arrears. And you have 2 different types. You have cumulative preferred stock, which means that if, let's say last year I didn't pay preferred stock any dividend, and I declared dividends this year and I have both preferred and common stock, guess what? The preferred, like we talked about earlier, gets preferential treatment, and they're going to get paid before the common shareholders. That's cumulative. Non-cumulative preferred stock means that they don't get paid, any different each year. It's basically the same. And so we look at this. It says, suppose Greg's Games preferred stock is cumulative. That means that they have to get paid for prior years or dividends in arrears that they didn't get paid for. So it says they didn't get any dividends in 2016. And so it says here, Greg's Games must first pay preferred dividends of $3,000 for 2016 and then $3,000 for 2017. And the remaining dividend amount will go to the common shareholders. So preferred gets their dividends before common gets theirs, particularly if it's cumulative. Even if it's non-cumulative and given the same year, the preferred shareholders are going to get their money before common shareholders. So here's what it looks like. And they paid their dividends. So you had $6,000 that you paid out to preferred and $44,000 that gets paid out to common. See, this is for 2016, this is for 2017, and the remaining goes to the common shareholders, and there's the math for that. A stock dividend is a distribution of the corporation stock to shareholders. What they're doing is they're saying, hey, we're going to give you shares of stock as opposed to money. And the reason they might do that is they don't have enough cash, but they can give you more shares of stock. And sometimes it's a good thing and sometimes it's a bad thing. There's no effect. Um, they affect the stockholders' equity account because it's going to increase the balance, and they have no effect on assets or liabilities. So why do they do a stock dividend? They want to conserve cash, like we talked about. They can reduce the market price of the share of their stock because it means there's more shares outstanding, and they can reward investors. Same thing, we have the same dates: the declaration date, the date of record, and the distribution date. And you have a difference here between a small stock dividend and a large stock dividend, and what happens. And you notice a small stock dividend is less than 20% to 25%, and it's issued issued outstanding, and a large stock is greater than. And you have the accounting for these is different. We're going to talk specifically about a small stock dividend. So in this, for our example here, they recorded stock dividends, and it's 5% of shares outstanding. So they had 2 million shares outstanding, so it's 100,000 shares. So it's a small stock dividend. And what we do is we're using something called the equity method, which they don't talk about in your book, versus the cost method. And what you're doing is you're going to debit stock dividends now. So it's going to be the same like a contra equity account. And you're going to credit common stock dividend distributable, which is basically like a payable, but in the stockholders' equity section. And then you're going to do paid in capital in excess of par common stock. And that's a 5% stock dividend. And when they pay out, it's just a flip-flop between the two. And that's the end of the journal entry for common stock. And here's what the common stock dividend looks like on the left side and on the right side. And it's a small stock dividend, but you notice the big difference here? The only real difference here is there's two accounts that have changed. This account changed by 100,000. The distribution, first of all, stayed the same. I mean, the total stayed the same, but it changed between here and here. You have 21,055,000, and you now have 26,055,000. So we moved 5 million out of retained earnings, from 9 million to 4, and put them into this common stock, and we distributed it between par and common. A stock split is different in that no shares change hands at all. It just increases the number of shares outstanding, and the only difference is the value of your stock. The par value of your stock is affected. That's it. And here's a little table. I'm not going to spend a lot of time on this. You can look at this in your book and just follow through exactly what happens with each transaction and what the effect is on stock split, stock dividends, and cash dividends. And how is that going to be reported on the balance sheet? It's in the statement of retained earnings. And if there's a negative amount, that means that there's a deficit. That means that the business probably had a major bad year, at least 1 year somewhere along the way. And here's what it looks like in the statement of retained earnings. Beginning retained earnings, net income, and declared dividends. For this particular example, it's really simple. This is stuff we looked at way back in chapter 1. And they can apportion retained earnings, and they're restricted by journal entries, and sometimes it has to do with what they call bank covenants. That's where this one, it says banks require a company to maintain a minimum level of stockholders' equity. That's a bank covenant. And if you have cash dividends and treasury stock, you got to make certain you have enough cash. Prior period adjustments are things that you found after you close your books for the year, and you have to make those corrections in your statement of retained earnings. And this is what it's going to look like. You notice here you have basically the ending for 2000, and this date's wrong. No, this is okay. But basically this number would be, the ending for 2017 would be this number. 2016, right? December 31st, 2016 would be this number. And then you found some adjustments that you need to make. You need to put those in your retained earnings, give you a new adjusted number, and then put your net income and do your dividends, etc. And these are things that they found maybe the inventory was wrong. And those are some of the things that's just one simple example. And here's how a statement of retained earnings looks like. This is a statement of stockholders' equity. It just gives you a pretty good idea what's going on. And then we want to talk about earnings per share and rate of return on common stock and the price per earnings ratio to look at company performance. Earnings per share, why does that matter? Because you're trying to understand how much they're making for each individual share of stock that's outstanding for the business. And they would do that because they want to determine, the investors want to do that because they want to look at that to determine whether or not they want to invest in your company. That's just one of the metrics that they look at. And then the rate of return, they're going to use that based off of a percent. And then they have something called the price earnings, or the PE ratio. So let's look at those each individually. Earnings per share, and it's used by all businesses. And you're just taking the amount of money that they made divided by the shares outstanding. So here's the example of Green Mountain Coffee Roasters. They're going to take the earnings per share, they're going to take net income minus preferred dividends divided by the average number of outstanding shares. So there's some big numbers here, but what it really boils down to is they made $3.19 per share. And that's a really important number for you to understand what that means. Because depending upon how much money you have in those companies, that will determine what they're really trying to tell you is how much money do they potentially have that they could pay out in dividends or pay to me. And you have the price earnings ratio, and you notice we're using this $3.19 per share that we calculated. Then we're going to take the $75 per share, and it's going to tell us that the price earnings ratio is 23.5 to 1. And they might talk about this in you'll see this on some of the shows on TV where they'll talk about the PE ratios for businesses, and really you have to benchmark it by industry. And you learn some of that stuff in your financial statement analysis class, but you're trying to benchmark it by industry. And then rate of return on common shareholders' equity. In this example, you can see the calculation. It's net income minus preferred dividends divided by average common stockholders' equity. And what it tells you is that they made 20%. That's a pretty good return on investment, considering that the benchmark, if you put money in a bank account, you're going to make less than 1%. So that's a pretty good return on shareholders' equity. So common shareholders' equity. So I wanted to show you this, and you get an understanding of what's going on there. Okay, that's the end of chapter 13. I hope you have a great day, and I wish you well, and I look forward to seeing you next semester. Thanks.